No, actually, I want to change my mouse as well because half of the hassles I had. Oh, I haven't put it in here. Half of the hassles I had with the mouse that I was using, being my keypad, has all sorts of special functions built in that I don't want to use. So just moving my mouse keypad over the, trying to move just to, I would trigger high acceleration zooming without meaning to. So let's hope this works better. Let's see. Okay, that's good. Okay. So what I'm going to cover is modelling Minsky's financial instability hypothesis. And because I ran out of time in the actual demonstration of Minsky, I'll take you through building a Minsky model that way. And then what is the impact of including the fact that banks create money into macroeconomics? And then finally showing a demonstration of the importance of including money and banks in macroeconomics by taking a model of loanable funds and converting it to a model of endogenous money, just by bringing in the realistic point that banks lend money to non-banks. That's what's left out of loanable funds that I include by a few simple changes in a Minsky program. And what I'll start with is the fact, as I explained to you in the last lecture, there's a strong non-equilibrium and non-labour theory of value component to Marx's logic, which is the sort of vision of economics that I want to build without the restrictions of the very mechanical labour theory of value. And it was a very simple non-equilibrium model. And out of it, it's quite a strange model because most of the first volume of Das Kapital is very much about extraction of surplus and is arguing that workers receive only the value of their labour power. So when you look at the first volume of Capital, if you read it, and I do recommend reading it, but after you read my introduction to Marx and after you read maybe the Goodwin first, which I think is a more interesting look at how Marx's logic developed, it has this verbal model where labour gets more than its value. Okay? Not the case that labour is exploited and surplus comes out of workers just receiving subsistence, but a cyclical model. So he starts off by saying there's a rise in the price of labour because of the accumulation of capital. So what he's saying is investment's been strong. There's a large increase in the amount of capital and therefore the amount of workers needed to work that capital. So unemployment is low. So he's saying in this situation there can be a rise in the price of labour, the wage rises. And he says because the wage rises, in the very simple model he's built, there's only capitalists and workers. So if there's an increase in wages, there's a decrease in profit. With a decrease in profit, there's less accumulation taking place because there's less profit. So capitalists are investing less money. So the rate of accumulation falls. And because it falls, however, now that wages are falling, again in a very simple two-class model, more of what is produced goes to capitalists. So they're accumulating more. There's a high rate of profit. And therefore, having had a high rate of profit of wages which reduce profit, you now have, because of a slowdown in the economy and a slowdown in accumulation, the price of labour falls, wages fall in real terms, so you therefore have more going to capitalists. And therefore, because you now have more money going to capitalists, they invest more, and there's a boom once more. And with the boom, wages rise again. So Marx finished off with this lovely line here saying, to put it mathematically, the rate of accumulation is the independent, but the causal variable, and wages are the dependent, not the independent variable. Now, that was a cyclical, non-equilibrium verbal model, and when you look at what Marx tried to do after he finished writing Das Kapital, because if you know the story of how Das Kapital was written, he wrote an incredible set of writings about all the opinions of the classical economists and people like Say as well, in what we now call the theories of surplus value, which there are 3 volumes of that, which is his interpretation of the writings of other economists. And he wrote the other, what we call Volume 2 and Volume 3 of Capital, before Volume 1 was published. So Volume 1 was the only volume of Capital that Marx personally oversaw. And then when he died, Engels worked on the leftover notes to write Volumes 2 and 3. So Volume 1 was the only thing Marx finished. And when you look at the plan that Marx wrote for writing Das Kapital, he had an intention of writing 6 books. Now, in my opinion, the 3 volumes of Capital constituted just one of the 6 books he intended writing. He never got to finishing the others. But this particular section really moves from what he had intended as the first volume of Capital, the first book, to the second book. Because in the first book of Capital, which is the only one he really oversaw, volume 1, he took the assumption that workers just receive subsistence wages. What he was going to do in the next book is explore what's discussed in this one very short section, where workers receive more than their subsistence, and then the dynamics that come out of that. So he never got to finishing it. But this was written back in 1867. Well, I think one of the most important people in economics has been forgotten, which is a great tragedy, is Richard Goodwin. And given that this is the school of complexity, I'd really recommend seeking out the work of Richard Goodwin, because he was the original economist who really pushed the importance of nonlinearity in economics and complexity. So you may not have seen anything by Richard Goodwin yet, but I would highly recommend, given the nature of your department, that people consider the work of Richard Goodwin. In 1967, precisely 1 century after Marx wrote that verbal argument, Goodwin developed a model which expressed in mathematics what Goodwin was saying verbally. And when you look at what Marx did after he finished writing and publishing volume 1 of Capital, he actually spent a lot of his time trying to learn calculus. There's a book now which you can now find for free on the internet called Marx's Mathematical Manuscripts. And he's attempting to understand calculus and writing it in a very dialectical fashion. It's interesting, but he was really, in my opinion, and in the opinion of some of the people who read those manuscripts, he was trying to do what Goodwin did a century later. He was trying to put in mathematical form the cyclical model that he discussed in chapter 25. So what Goodwin saw was that there was a similarity between this model and predator-prey models. But the intriguing thing, who do you think is the predator in this model? You know, you basically got your predator-prey model, fish eat sharks. Okay. Who do you think are the sharks in this model, mathematically speaking? Who are the predators? We have capitalists and we have workers. Who do you think are the predators? Mathematically, it's the workers. Okay. Looking at the structure of the model, when you solve the model, it is that the workers are the predators, the capitalists are the prey, which is not the sort of result ideologically you'd want out of a Marxian background. So it shows that this is something which transcends the normal understanding of Marx. But it's a very simple. When Goodwin realised it, he then put it together in a system of 2 reduced form differential equations. But you can derive it in a very logical fashion by saying that the amount of capital you have, roughly speaking, determines the amount of output you can produce. Okay? The ultimate constraint on your capacity to produce output is the amount of factory capacity you have. So the first step is capital determines output. And then once you have output determined, you've built your factories, you decided to produce a certain amount of output, that largely speaking determines how many workers you're going to hire. So capital determines output determines employment. When you have the amount of employment you've decided to create as an overall capitalist system, then that's going to determine the rate of change of wages, because again, in common with most economists, Marx had the idea that the level of employment of workers determined their bargaining power. So the higher the level of employment, the more bargaining power workers had. Therefore, the rate of change of wages was to a large degree determined by the level of employment. Given the level of employment and the fact we've worked out employment here and you have the rate of change of wages, so you can derive wages, you can now work out what profits are, because it's a very simple 2-class system. There's only workers and capitalists. So having determined what output is going to be, subtract wages from output, you get profits. And in the model that Goodwin put together, profits determine investment. So profits then are completely invested in the simple model Goodwin had. And investment is the rate of change of capital. So you've closed your loop. You have a loop from the level of capital to the rate of change of capital, and you have a causal cycle. Yeah?
I wonder why there is employment between rate of change of wages, but not the level of wages.
Because the basic argument of the Phillips curve, which we now call it the Phillips curve, but you can find it back in Marx, is that the rate of change of wages depends upon the level of employment. Again, Phillips's work. Phillips is an important, highly neglected individual in economics. There's an Australian historian of economics called Robert Leeson, L-E-E-S-O-N, who's done an enormous amount of work to show what Phillips was actually trying to achieve. And Phillips was an engineer.
Yeah.
He was, first of all, an engineer, and he converted to economics. And what he was trying to do was bring engineering concepts into economics. So the work he did back in the 1950s, 1950s mainly, was attempting to build the same sort of dynamic models I'm showing you now. So Phillips is an important, extremely neglected individual, again, in economic theory. And when he developed the Phillips curve, he actually argued there's not one factor, which is the level of employment. He said there are three factors that determine the rate of change of wages. One was the level of employment. The second was the rate of change of employment. And the third was cost of living pressures. So you had three factors in what he said determined wages, not just one. This is completely ignored in the conventional interpretation of what Phillips was on about. And what Phillips is trying to do is, actually he was the world's first systems engineer. His work actually predates Forrester. And he was trying to bring system engineering concepts into economics. If you look for the papers that Bill Phillips wrote in the 1950s, you'll find quite sophisticated systems dynamic concepts there. He was trying to bring economists across to thinking in this way. And the hydraulic model he built, he also built an analog computer. So it was actually electrical circuitry using valves, resistors, and so on, and of course predating transistors. So he built an analog computer of the economy, as well as hydraulic-based models. So Phillips is a massively neglected human being, and I really recommend, given the nature of your department, it's worth getting some graduate students to go back and read those original papers by Phillips and see what he was trying to build. But this idea here is that employment rate determines the rate of change of wages is one of three factors that Phillips had in his model. If I wanted to build a more general model, I'd include the other two factors. And now, in fact, you could do it in Minsky. It's a worthwhile exercise to do it. But to put this...
What is the last one?
Cost of living pressures. Cost of living.
Cost
So
of
if workers, as well as workers would respond to three things. You said the level of employment determines part of your bargaining power. If you have then the rate of change of employment, so if they have a positive rate of change of employment, so employment is rising, even if it's low, that also adds to your bargaining power. But if you have a high level of employment and the rate of employment is falling, that reduces your bargaining power. So second differential effect. And the third factor is that workers will bargain where they have the power for compensation for changes in the cost of living. So you can have a lagged response to inflation turning up in your wage demand. So to do a proper analysis of Phillips, you need to have those three factors. And I'm just doing one here. It's quite simplistic. But even this simple model gives you quite strong cyclical behaviour. So to build through this model, the first stage of it is to say that the level of output is capital divided by capital output ratio. And the second bit is to say that labour is output divided by a labour output ratio. The third stage is then to say, given employment, divide that by population and get an employment rate. And then with a linear Phillips curve, and Phillips, by the way, was very emphatic that the relationship between the level of employment and the rate of change of wages was nonlinear. Again, when he first, Phillips did his empirical research for what we now call the Phillips curve in a weekend in 1957. Literally over a weekend. He borrowed a calculator from the library, from the secretary of the economics department. He managed to put together about 6 or 7 different data series taken from trade union records in England from the 1850s through to the 1950s. And he then did hand calculations on this old-fashioned calculator over a weekend. But before he'd done that, in one of the papers where he did the system dynamics modelling, he drew a nonlinear relationship between the level of economic activity and the rate of change of factor prices, which is just a nonlinear drawing. So what he did when he did the empirical research was he was trying to find a justification for this nonlinear drawing. So his concept predated the data. And it was really an input to a dynamic model. It wasn't a case of him saying there was going to be a trade-off between a certain level of unemployment and a certain rate of inflation. He did make that statement in his paper on the empirical data, which was one of the biggest mistakes in economics to ever state it that way, because he really, if you look at how he's feeding it in, because it was a dynamic relationship, you would never stay in one point. Okay? He was talking about unstable and cyclical systems. So the idea of a static, stationary trade-off between employment and inflation wasn't part of his model, but he wrote that as a throwaway line in this empirical paper, and that became seen as the basis of the Phillips curve, which is entirely wrong, but still. So just for simplicity, Goodwin used a linear Phillips curve, and I'm using the same thing here just to show you that the cycles do not depend upon having a nonlinear relationship. Again, one of the big mistakes in people when they think about nonlinear dynamics is to believe that the nonlinear dynamics come out of assumed nonlinear behavioural functions. What I'm going to show you here, which in this audience you're aware of it, is that the nonlinearity comes of interactions between system states. One variable multiplied by another is a nonlinearity, and that's what we see in the system. So using a linear Phillips curve here, I then argue that the rate of change of wages is this nonlinear function multiplied by the current wage rate. And then wages times labour determines the wage rate times labour determines the actual wage bill. Output minus the wage bill is profits. Profits is, in the simple model, all profits are invested, which is the absolutely linear model on that front. And investment minus depreciation is the rate of change of capital stock, which gives you pay up here. So it's a causal loop. So building that in Minsky, I'm going to use the following parameter values. Got a capital output ratio of 3, a labour productivity ratio of 1, a reaction of workers to the unemployment rate of 10. So for every difference between the stable level of wages and the level which causes rise or fall, the ratio of change of 10, a stable level of employment of 90%, so 10% unemployment wages don't change, and a depreciation rate of 10%, and a population of 120, so I'm going to starting off with some unemployment in the system. So initial conditions are going to be 300 units of capital, a wage rate of 80% of output, which is below the equilibrium level. Now let's see what happens. So I put that all together, I get a model like this, and I'll just bring up the model and simulate it. I could build the model during the lecture. Would you like me to do that, or just show it to you? So here we have the rate of change of capital divided by the capital output ratio gives you the level of output. And then the level of output divided by the level of labour productivity, so how many units of output are produced per worker, gives you the level of employment. Level of employment divided by population gives you the employment rate. I then feed the employment, take the employment rate, subtract the stable level of employment, the level at which was wages to remain constant from the actual employment rate, multiplied by 10, and that gives the wage change function that workers have. Multiply that by the actual wage, integrate it, and that is the actual wage. That's the rate of change argument there. Multiply the actual wage by labour, I get the wage bill. Subtract the wage bill from output, I get profits. In the simple model, all profits are invested. Gross investment minus depreciation is the rate of change of capital stock. So that's a basic cyclical model. Now, from a neoclassical point of view, are you going to converge to equilibrium? The answer is no. I'll slow the simulation down so you can see it happen here. But what you get is a model with permanent cycles. And what I find amazing is that neoclassical economists struggle to understand why you get cyclical behaviour. But a very simple structural model like this gives you inherently cyclical behaviour. Now, notice the cycles are constant. There's no change in the amplitude. If I changed parameters here, like for example, increasing labour productivity, then I get changes, as you can see in the dynamics. If I change the capital output ratio, I get other changes, etc., etc. So you can modify the model and see what the impact is of various changes in output levels and so on within Minsky itself. But fundamentally, the model itself generates cyclical behaviour. So the way that I developed my model of Minsky was to take that model, and here I'll give another accolade to someone who's also very neglected. There's an Austrian-born but Australian resident mathematician called John Blatt. And John Blatt was the one who wrote a brilliant book called Dynamic Economic Systems. Again, it's a book I highly recommend. I have a PDF of it. It's out of print, but I can give you a PDF scan of the book. That to me is one of the most important books on the need for a dynamic approach to economics. And he does a brilliant explanation of Goodwin's model. And he points out that one thing that comes out of Goodwin's model is the shape of the trade cycle looks like the actual trade cycle. A long, slow boom, a sudden slump. A long, slow boom, another sudden slump. When you look at it, you get this, what's called sawtooth appearance of the trade cycle. And Goodwin and Black argued in this book that he thought it was, mathematically speaking, the most valid model he'd seen in economics. He said what it lacked was a cause of instability. And he argued that it might be interesting to bring in the financial sector to see what could happen to the model. Now, one little cameo for me, when I was writing my PhD, one thing I did was critique Hicks's theory of the trade cycle. And I submitted a paper on that to the Economic Journal, and it was rejected on the basis of one referee's report. After it was rejected, I received a letter from Richard Goodwin saying he strongly recommended publication to the Economic Journal. So they rejected on the basis of one negative referee's report and one positive referee's report. But he said that he liked the work I was doing, but he said to me he didn't like the fact that I was bringing money in, because he'd done his PhD between the First and the Second World Wars, and he concluded that money had no impact on the economy, which I think was a wrong conclusion. Ironically, he also told me that his own father owned a bank in America that went bankrupt and put his family into poverty when it went bankrupt. So he thought it had, despite this personal experience, he thought money had no role in the economy. He encouraged me not to continue doing monetary work, but to look at the real economy, which I ignored. But he also told me that Minsky worked at the same university department he did. And the way he described it was quite strange. He said Minsky swanned in from some other university. And there was obviously a clash of personalities. Goodwin was, from what I can tell, a very extremely friendly, very warm human being, and he was a talented artist as well as a leading mathematician. Minsky, on the other hand, from what I can tell, wasn't a very nice person. He was rude. And the two clashed, and they never really communicated or worked together, even though they were in the same department. So I find it amazing that what I'm doing is bringing their work together when they could have done it themselves 40 years ago. But what I did was take Goodwin's model and take Blatt's advice that you should bring the financial sector in. And having read Minsky, what I was trying to do is model Minsky. So I thought I'll take Goodwin's model, which is a naturally cyclical model, and then add in the financial sector, because capitalists don't invest all their profits. They invest more than they earn during a boom and less than they earn during a slump. And for the sake of illustration, I'll use a linear model here. So the reason for using a linear model is not that I believe a linear model describes what capitalists do or even what workers do. It's showing that even if I use linear models, I've got nonlinear phenomena coming out of the system, up to a certain point, up to a three-dimensional model. So what I'm now arguing is that profit the rate of profit is the level of capital, profit divided by the level of capital. So I have, and the level of profit is output minus wages. And I then have an investment function where the level of investment is the actual rate of profit minus a rate of profit that keeps workers, capitalists happy, multiplied by a reaction function. So exactly the same designer function that I used for workers, but now applied to capitalists and how much they'll invest. And I'm ignoring where they get the funds if they're desire to invest is greater than their profit, and what they do if their desire to invest is less than their profit. Just ignoring that right now, but I can bring it in a moment's time. So I bring that in. I have an argument that capitalists, if they earn 3% rate of profit, then they invest 3% of output. So that's the level that is their equilibrium point, if you like. Their slope reaction is 10, so the same value I gave to workers. And let's see what happens. And what you get is no apparent change. Still the same sort of cycle. So I bring that model up. So I've now added down here, let's make it a bit smaller. I've now added profit here, divided by capital gives you profit rate. Subtract the equilibrium level, you get a gap between what the actual rate is and what the level that keeps capitalists investing just what they earn is. Multiply that by a slope function, you get the actual level of investment. Multiply that by output, you get investment, and then on you go. If I simulate it, I get the same cyclical behaviour shown you a moment ago. So it doesn't actually change the nature of the equation. And that's because we're still working with a two-dimensional system. And this is one thing which, if you work in complex systems, you'd be aware of this, but anybody who doesn't would not necessarily be aware. A two-dimensional system only has three possible types of behaviour. Either you converge to an equilibrium, or you spiral away from the equilibrium, or you spiral towards a limit cycle. And in this very simple model of Goodwin, you're actually on a closed cycle. It's not really a limit cycle, it just continues repeating itself. Those are the three possible behaviours. Nothing else can happen. But adding more realism, of course, when capitalists want to invest more than they earn, they borrow from banks. And when they earn more than they want, they pay banks' debt back. And banks charge interest. So that now adds these simple equations to the model. The actual rate of profit is net profit divided by capital, and that's output minus wages minus the interest rate on existing debt. So including debt inside there. And the rate of change of debt is investment minus net profits. And of course the net profit includes paying interest on the debt bill, so that's where the interest rate turns up. So I added the parameter value that happens to have a rate of interest of 5%. And let's take a look at it. And when you run it, you get the same sort of complex behaviour that we see in the real economy out of an incredibly simple model. A tiny number of parameters in this model. Notice what's going on. I'll bring this up in a second. What we have is apparent declining volatility. So for a while, the cycles in employment decline. And if you have a linear neoclassical vision which ignores the role of debt, hey, the great moderation. Isn't it wonderful? We're making the economy better. Then you have rising volatility, which they can't explain, and a rising ratio of debt to GDP, and a declining share of workers' wages in output. So as wages fall, inequality rises. The total wage bill falls. Now all those things actually turned up in the real data, just to demonstrate that model. Now, let's see, make the scale a bit smaller again. By the way, there's a new version of Minsky just uploaded 4 hours ago by Russell Standish. He's addressed some of the bugs I was showing you yesterday. Okay, so go to the website, go to the beta, and download the latest beta of the program. I think it's knocked up some of the most important outstanding bugs, and it may be the next release version we have. But now what I have here is here's investment, and then I have investment minus profits is the rate of change of debt. And you multiply that debt by the interest rate, and you get interest payments, and then subtract interest payments over here from net profit. So a simple way of including that dynamics in Minsky. Let's make it a bit smaller and run the model. And I'll slow it down a bit. What you can see is here's this declining volatility followed by rising volatility. Because it's a linear model, the volatility is equally distributed around the equilibrium, or around the average, not around the equilibrium. So you get booms and slumps, and if I run this indefinitely, I'll just run it a lot longer. You get bigger and bigger cycles, and you start getting impossible values for the employment rate. Let's try it longer than that again. Notice this is the employment rate of 1 plus 1. actually ultimately finding there is a crash, a total crash in the economy. Employment falls to zero or negative. So you get a debt trap coming out of this model without imposing nonlinear assumptions upon it. So the role of bringing in nonlinear assumptions is not to generate the result you want, it's to make the results more realistic. Because you don't get employment of 150%. Okay? You get it being cut off by increasing rates of increasing wages. Now, what I've spoken about so far in my presentation with you is a model of a pure credit economy, no government. But of course, in the real world, we have a government. And if a government behaves passively with respect to the rate of change of the economy, but has a welfare system and has taxation systems, then you can regard what the government does as paying a subsidy to firms. And during a boom, it reduces the subsidy, or actually makes the subsidy negative. But during a slump, it pays a positive sum. So that's a simple way of taking into account the existence of a government that behaves in a counter-cyclical way. So what I bring in here is to say that the rate of change of government spending as a percentage of GDP is a function of the employment rate. And net profit now includes that government subsidy. So I now have output minus wages, minus interest bills, plus what the government is paying as a subsidy by the government's capacity to create money. And then what I do now is also replace those unrealistic linear models with a generalised exponential function for each of these arguments. So the wage function is a exponential function now. So that argument you see there is a generalised exponential function. It takes an argument which is a minimum value for the exponential, so all exponential functions reach a minimum value. An xy coordinate, so ye and this is the wage function, ye and xc happen to be an equilibrium point. So at that point, the value of the function is zero, and a slope at that point. And you can fit that to any exponential, a positive or a rising exponential or an exponential decay. It's quite easy to choose your parameter values and you get the argument you want to fit that. So when I add that, what I get is a system with complex cycles. I'll bring that up and simulate that. So now what I've added is a government sector. And the government reacts to the employment rate. Given the employment rate, it pays a subsidy to firms, creating a debt for itself in the process, and that subsidy is part of profits. Let's just make that smaller so we can see the whole system. And what you've now got is a four-dimensional system. So of course, to actually properly display this, I'd need to have a three-dimensional graph with colour, which I'd like to have the money to pay Russell to develop so they can actually do it, but we haven't got there yet. So if you now look at these two systems here, this is going to be the cycle of the employment rate versus the wages share, and this is private debt versus government debt, which are the two other system states. Let's slow it down a bit because it runs rather quickly. And what you see for a while looks like we've reached equilibrium over here, but notice you're still getting complex dynamics down here. And then, when this appears to have reached equilibrium, suddenly you see complex cycles. Oh damn, I shouldn't double click like that. Just caused a crash. Let's bring it back up again. Another bug to show Russell later. Let's go again. I'll bring it up now. Let's see if I bring this one up. Oh dear. Okay, Russell, I've got another bug for you. Great. We're not quite at the release version yet. Let's simulate it without bringing out one of the Zoom graphs. And I'll slow it down quite a bit. So you get a system with complex behaviour, but without breakdown. Cycles persist indefinitely. Again, I apologise that I can't make the scale better than it is right now. Let's speed it up a bit. Notice the cycles over here in the employment rate and wages share. And what you start seeing is an extremely complex pattern with booms and busts, and then big scale and small scale booms going on indefinitely. Now, from a neoclassical point of view, there must be lots of exogenous shocks. In reality, absolutely no shocks. It is all endogenous dynamics.
It's
Yeah.
like a fractal.
Yeah.
It's
Yeah.
very inside the
Yeah.
cycles.
Yeah. So that's, yeah.
Will it converge to a point?
No. No, it doesn't. Take a look at these cycles here. I want to run it faster and just take a look at the, you can tell by the thickness of these graphs. I can't stop it because you saw the crash a moment ago. But we're at 610 years now. Okay, there's the T up here is the number of years the simulation has been running for.
But look at the private debt ratio and public debt ratio.
Yeah,
They
well, the public debt is only varied by a very small amount. Like if I change the zoom there, this is going to look messy, but it's the best I can do, given that it'll crash on a smaller graph. You've still got changes going on. Let's take a look at this one. If I resize that, again, this is rather remarkable that I can resize the graph while the program is running and move it around. But whoops, I'm going to do that. Let's see if I can drag. Ah, damn. Let's try again. I'll just make those graphs. Let's see if I can. I'll make this one much larger. I'm going to obscure the dynamics of the rest of the system. But those cycles go on indefinitely. It never reaches equilibrium. So the dominant eigenvalues, it's a four-dimensional system, so there are four eigenvalues to the system. And the real parts of the two dominant eigenvalues are positive. So you'll never settle down, you'll never stop cycling. But it's entirely endogenous cycles. The simulation will be running now for 1,000 years.
But it seems that it is fluctuating along some kind of line.
There's now, the long-term fluctuations have disappeared, the short-term is still there.
Yeah.
Okay? Yeah.
But no long-term change.
Yeah. So this is reflecting the behaviour of the government sector that counter-cyclical behaviour, and where also it continues defending a fixed level of unemployment. It won't let unemployment fall below a particular level. If you look at Western governments, like my Australian government, used to be really panicked about a rate of unemployment of 2%. At that level, they try to stimulate the economy. They go to 2% is too high. Now they accept 6%. So real governments have moved away from the type of behaviour I'm showing here. And I think it's partly why we're seeing more extreme cycles now and not larger accumulation of debt. The welfare system is less responsive. So rather than seeing its role as being to try to prevent the downturns of the private sector by providing cash flow when unemployment rises past a certain point, they accept that increase in unemployment. Is that a good point to stop at, or we have 5 minutes to go? I'm happy to take a break at this point because I'm going to move on to another topic after this one. Okay? Let's stop at that point.